All right, well, let's keep rolling. Next, we're going to talk about comprehensive business succession and exit planning with the use of life insurance. Stacey McMahan from Pac Life is going to be presenting for us. Stacey got her law degree from Pepperdine, and before that went to that university in Ohio, which some of us are not as crazy about, but that's okay. She's a good Buckeye and a dear friend. So please welcome Stacey McMahan.
Hi, everyone. Thank you, Carla. Good to see you, Carla. I know we've been chatting the last few months, preparing for this this group of speakers and presentations here. Let me pull up my screen. I think that's the next step here. Hopefully I can do it without any issues. All right. I think the best way I've found to do is the reading pane here. Can everyone see my screen? Carla? Okay.
Yes, I can see it.
Okay, I can see it. So.
I can see it.
Okay, great. Thank you. All right, great to see everybody. As you can see, I know there's a business succession presentation. I think it's tomorrow. There's another one with a little bit different topic, different details in it. But today we're going to talk about, as you can see here, what we call comprehensive business succession and exit planning. And that just means we're not talking about the nuts and bolts of basic business succession and exit planning. We're going to walk through a couple of unusual strategies, I would say. Maybe you've heard of some of these and maybe you have not. But really, we're taking some buy-sell strategies and adding a little bit of a twist. So I don't want to do a spoiler or anything, but we'll take it away from here. I'm going to try to, hopefully we can, okay, just need to click as usual. All right, so our basic disclaimers here. I wanted to not forget to let everyone know too that we have been watching tax reform. I'm sure several of your speakers on for Impact Week here are aware of it as well. And I think we're going to be talking in November about tax reform a little bit more, but there may be some things that you're curious about, and they may come up in this presentation, just very a couple little provisions in there that are being proposed. But as you know, the Ways and Means Committee, Chairman Neal proposed to put a plan together, and it's got all kinds of bells and whistles to it. We're not sure what's going to happen with that eventually, what's going to actually be included in the law. But the Advanced Designs Unit, Pacific Life, as well as all the other carriers out there, I'm sure are keeping a very close eye on it as it moves through Congress. And so we'll be watching for that. So we will have a December 7th webinar. So let me know if you're curious about that, or let Carla know if she can get the information to you about that. It's going to be December 7th at 9 a.m. Pacific time. All right, so this is just a little bit of food for thought here, a couple of points that you're probably all aware of. So many of your business owner clients are not prepared, right, for exiting the business. They think they are, or they maybe think they don't need a plan. Like we see, this was a survey that 50% of small business owners without a plan don't think they really need one. They're planning on just working through retirement, or they're going to get it down to their adult children or whatever the case is, but they're just not really interested in planning. So we have some reasons here, other reasons why they're not looking to do any planning, or maybe haven't done any planning. They don't have a successor in sight. Are they just not worried about it? They're trying not to think about the future because this is their livelihood, this is their baby, and they cannot imagine life without their business. I'm sure we all know some business owners like that. So getting out of the business just isn't even on the front burner for them. And also, but just for those that do want to do some planning and know they need to do some planning, they're just super busy people like all the rest of us. They just haven't taken the time. So we want to make sure that your business owner clients who do need to do some planning get something in place. And we're just going to give you some ideas on how to help them do that today. So we'll take a look here. Another, couple of motivating tips for your business owners, clients. 40% of family business owners are expecting to retire within 10 years. So you can see, again, a lot of them are not planning to plan on retiring anytime soon. They do need your expertise, and they need some strategies, and they need somebody to help them walk them through it. We've all heard the statistic about, 2/3 of the family-owned businesses don't survive to the next generation. Why is that? And I think a big reason is because they're just not doing the planning. There's a premature death, unexpected disability or something. It's really difficult to keep the business going at that point. And if you're talking about getting it down to the third generation, it's even a slimmer chance. So only about 10% make it to the third generation. So we can, you're the key point person with your business owner clients. I'm sure you're reminding them, hey, what about your surviving spouse? We don't want to have them go through a hardship. We don't want a fire sale. Again, of course, if there's an unexpected departure from the business or an unexpected death, that fifth bullet there is, unfair treatment of family members. If there's a child who's involved in the business and the others aren't, we have some ideas on how to, make that estate planning go a little bit more smoothly for that family. Certainly, change in insurability, health issues, all that. We want to make sure that your business owners are as prepared as possible. All right, so when we talk about business succession and exit planning, we always typically think of a couple different types, which I'll go to here in a minute, but we want to kind of lean away from the cookie cutter approach, at least for today. Sometimes that works just great. That's all the clients might need. But if your clients are looking to do, maybe some retirement planning, in addition to their business succession planning, maybe they need to really shore up some of their executive benefits and keep some of those executives around if those are the people that are expected to take over the business. We have some, there's obviously some ideas on that side. So you'll see here when we talk about our strategies, we're really looking at a comprehensive, customized approach, not just, hey, do I need a one-way buy sell or do I need a stock redemption buy sell? It's a little bit more complicated than that. So as I said, sometimes the business owners are looking to get their business down to the next generation, maybe at death. That's not a bad option. There's certainly ways we can help with that with life insurance. Do they want to catch up on retirement? Maybe they just need some basic family protection and they haven't done that yet. How many have clients that have zero family protection in place as far as at least some term life insurance? So what we're going to take a look at is, how to identify their goals and concerns, and then figure out which strategy is going to work for that business owner client, and then potential funding options. Of course, there's other things besides life insurance in the world, and we know that. So we'll take a look at those different types. So again, our 4 basic types, I'll cover that in a second, but the strategies we're going to cover today, this is the meat of our presentation, or the plant-based protein of our presentation today. My doctor told me I need to eat more plant-based things. I really like steak. The meat here is we have got ESOP, we have an employee stock ownership plan. We're going to talk about all the details of that. The defined benefit plan, the buyout, of course, these are all relating to the buyout of the business, and a SERP, supplemental executive retirement plan. So let me just first cover our basic, just in one slide, we're going to do a drinking from the fire hose buy sell presentation here. We do have a presentation pretty much solely on these 3 or 4 types. But today, obviously, we're going to be talking about the more comprehensive ones, but just wanted to give you a quick overview. Stock redemption, of course, or sometimes called entity redemption or entity purchase or stock purchase. That's where the business is doing the buying out, right? They're redeeming those shares. And if you're going to have a business is obligated to buy the deceased or the departing business owner's stocks or interest in the business. And so in this case, if you're funding it informally, funding it with life insurance, you'll have the business own the policy. Business will be the owner beneficiary of the policy. Assuming we fund it with cash value life insurance, that business can access the cash value if there's a lifetime buyout needed, or of course the death benefit is there if there's a premature death of one of the owners. If you're looking at a business owners who want to own their own policies on each other, we can do what's called a cross purchase agreement. So if there's 1 or 2 business, obviously if there's 2 business owners, They are going to buy policies on each other. That's only 2 policies, right? But if we have 3, I'd say 3 is pretty much the max for a cross purchase agreement, because 3 people, you need 6 policies, and that's getting that's getting into the limit there as far as expenses go. They own policies on each other's lives. So if owner A passes away, of course, B and C are obligated now to buy out those shares from A's family. So in that situation, we have we cross purchase those policies, and we have each owner is the owner and beneficiary of their own policy on all the other owners' lives. So it gets a little bit complicated, as I said, especially if it's more than 2 or 3 owners. We'll talk about kind of other issues with cross purchase and stock redemption, which one may be the best fit for your specific business owner. And wait and see buy sell, we don't really hear about that as much, but that's kind of a hybrid, right? If your business owner is not sure what they want to do, they can put together a wait and see buy sell, and basically it's the business has the first option to buy out the departing or deceased business owner. And if the business chooses not to exercise that option, then it switches over to the other owners to buy out the interest from the family or from the estate. Now, if in that situation, if the business owners say, nope, we're not really interested in doing that right now, then typically the business is has the ultimate obligation to do the buying out. And what do we see as far as life insurance in that situation is we typically see cross-owned policies, because the business probably most likely has more access to cash flow. They might have a policy in place already for an executive benefit plan or a key person or something. They can access those funds to do the buying out. Or if they even need to, we take those cross-owned policies that were purchased when this buy-sell was set up, and those owners can even make a capital contribution of those policies to the business to allow for that business to have access to that cash value. And our one way, of course, is very simple. We have a sole proprietor, a sole owner of a business, and doesn't have to be a sole proprietorship, but any type of business with a sole owner, and we have one executive or even 2 executives, 2 other non-owners buying out the owner. So it's like a cross purchase, but it's just going one way. So of course, the executive and the non-owner would buy the policy on the owner's life in that situation. All right, so here, this is what I was referring to when we look at these different factors of how do we decide which type of buy sell to use, whether it's entity redemption, cross purchase, etc. A lot of times people don't think about their basis increase, right? They all have a basis they put into the business. If they are selling it during lifetime, you always want as much basis as possible to reduce those capital gains, right? No issue at death as the law stands now, because everyone gets a step up in basis at death. So there's not going to be any capital gains for those who inherit the business assets there, but if they sell it immediately. We'll talk about that in a second here, which party owns the life insurance, and whether it works for, let's say, a sole owner, or if it works for many business owners. So back at the top there, our full basis increase, I have maybe, because entity redemption is where, of course, the business is doing the buying out. If you have a C corporation, there's not going to be any chance for getting any increase in basis, right? The business is doing the buying out. The owners who are doing the owners aren't doing the buying out. They're just getting an increased value of their business shares, because there's one less owner there now, but they're not getting any increase in basis. With a S corporation, they can potentially do what's called a short tax year election and get a full basis increase. If they don't do that, or if it's then they're only going to get a partial increase in basis, because what happens is at death, it's a whole presentation on this, of course, just covering the highlights here. There's a partial step up in basis, because the deceased technically gets an increase in basis, which is wasted because their assets get a full step up in basis at death anyway. So it's a third, a third, a third. If there's 3 owners, how do we get that full basis increase? S corporation, they do a short tax-free election, and then the death benefit proceeds are allocated solely to the surviving owners. Or it's even easier with a partnership or an LLC. They just have something in their operating agreement so that the funds are allocated only to the survivors. Of course, cross purchase, they're doing the buying out, so they get that full basis increase, and wait and see. Of course, it depends on who's doing the buying out and what the entity type is. And one way buy sell, of course, yes, they're going to get that full basis increase. They're doing the buying out, and there's only one owner. So a lot of information there. Let me know if you have questions on that. Which party owns the life insurance? Of course, we just mentioned this. At a redemption, we have our business as the owner of the policy. Cross purchase, we're cross owning the policies. All the owners will own at least one or more policies. Wait and see is the same thing, and with one way, we just have that one policy with the successor owning a policy on the sole business owner. Again, I mentioned what works for the sole business owner. That's our one-way buy sell. What works for businesses with many owners, if we're more than 2 or 3, definitely not cross purchase. One way doesn't really apply. Entity redemption, yes, we're going to be looking at that for many owners. Also, a little twist on the cross purchase, we call it insured controlled cross purchase. Sometimes they can own their own policies on themselves and just endorse a little bit of the death benefit over to the other owners. So again, that's called insured controlled cross purchase. There has to be a partnership somewhere in the mix to avoid the transfer for value rule, which is very bad. It causes taxation of the death benefit, which we typically don't see. You don't want that to happen. And then again, wait and see. It's not going to be likely if the policies were all cross-owned. Okay, so a lot of information there, but just this is the conversations we have with our advisors and producers and our wholesalers. We have to know a lot of details about the business and what they're planning to do and what their goals are and what the entity type is, how many owners, maybe the health status and age can make a difference as well. All right, so getting on to our advanced strategies here, an ESOP. Some of you have, I'm sure, had some experience with ESOPs. Pacific Life does not do the administration of ESOPs, and there's no actual life insurance typically owned inside an ESOP, but the business can have. There's about 3 life insurance strategies I'll talk about in a minute. But just to give you a quick overview here, this is our situation where there's no identifiable successor or third-party buyer out there. Maybe they've been looking, or maybe they just want to do an ESOP because they've heard about it and they're aware of this strategy. But that's typically where it comes to an ESOP. If you have an identifiable buyer, they could buy part of the business and the rest of it could go to the ESOP. It's just there's all kinds of variations on this tune, of course. So the strategy is basically here we're selling the shares to the ESOP, and we're getting those shares allocated eventually over to the employees. It's a type of qualified plan, so any contributions are going to be tax deductible, just like they are to a regular qualified plan. But this is a qualified plan that's a little bit different. It is investing primarily in those employer securities, right? So it gives us an avenue for that business owner to sell the stock to somebody. In this case, it's the employees via the ESOP. It's a plan. There can be a trust involved there as well. So it gives the employees a little bit of a stake in the company. We see a lot of ESOPs are grocery stores. For some reason, a lot of engineering firms are ESOPs. The bigger engineering firms, we've seen that. Then just to be aware, anytime you have a qualified plan, you have to have, of course, a third-party administrator, and you need to be following all the ERISA compliance, just like a qualified plan there. And I think it has to be an S corporation or a C corporation. That business is going to fund the ESOP either through the sale of those shares to the ESOP, or they can make capital contributions to it. And the ESOP is going to, of course, purchase those business owner shares at the business owner's retirement, and that's how they get their buyout. Now the ESOP is still continuing, right? After that after that business owner retires. So they make allocations to the employees, and then upon a qualifying event, just like a qualified plan, retirement, or death, usually those are the two biggies, those employees will get paid out their balance from the ESOP. So it's a lot of bells and whistles. There has to be the right type of business. I think it has to be a little bit bigger revenue for this to work typically, which makes sense. And again, as I said, it has to be S corporation or a C corporation. I have a couple of folks that we can refer you to. We haven't vetted them or we're not partnered with them, but if you're curious to find out more about ESOPs, I can definitely get some folks for you to talk to on that. Let me think. I meant to talk about the 3 life insurance sales here. I thought that we had a slide on that. So number 1, anytime you're creating an ESOP, there's an eventual repurchase obligation. The business has to buy back those shares eventually, so to get them down to the employees. So we want to make sure that we have funds for that business to be able to make those buy those shares back and from the retiring or deceased employees. So one way to do that is fund it with life insurance. So the business could buy life insurance on the key people, just have key person insurance there, and then that would give them access to that cash value via loans and withdrawals. A second life insurance sales idea is just a really good strategy to have. Basically, is to have so you want to have a strong management team for that business, right? You want that ESOP to be continuing. You want the business to remain strong. So, hey, we could put some executive benefits in place, deferred comp, and informally fund it with life insurance. We can even do bonuses, etc. So life insurance works there as well. And also, when you think about an ESOP, typically you might think, okay, well, 100% of the shares are going to be taken care of through the ESOP. Well, not necessarily. Sometimes it's only 50% or maybe 2/3 of the business shares are sold to the ESOP. The remaining shares could be taken care of with a side buy-sell agreement. So, a stock redemption. I suppose it could be a cross purchase as well. But if the business is doing a stock redemption, then of course the business would want to have some kind of sinking fund there. And life insurance is a great way to have that tax deferred growth in the asset and have access to that cash value to effectuate that buyout. There's our ESOP. Lots of, as I said, lots of bells and whistles, and I can get you to the right people to talk about details on that. I can talk about the life insurance side of it all day long. We just want to make sure that people are aware that there is an ESOP plan option out there. The second one I'm going to talk about here is our business succession with a DB, a defined benefit plan buyout. We call it a DB plan buyout. So with all these, as I said, now this one and the next one are going to have some kind of buy-sell arrangement, but we have other concerns. So for example, here we have Sam. He's 55 years old, about 10 years away from retirement. He has a business he thinks is worth about $3 million. He's talked to his CPA or his advisor or some kind of appraisal company and gotten a good idea of how much his business is worth. So he's pretty sure it's worth about $3 million. And that's what he's relying on for his retirement, right? A little doggy in the background. That's our working from home environment here. He's married. He has 2 children, 2 adult children. They're both involved in the business. And he really doesn't, in this situation, we're looking at someone who maybe doesn't have a whole lot of retirement assets, or they're looking to have more retirement assets than just the sale of the business. So Sam's 2 big concerns here are, hey, I want to make sure I don't put undue stress or financial burden on my children or the business. I want this business to succeed. This is my legacy. And he just really doesn't want to go back into the business after retirement. He wants to enjoy his golden years with his wife and not have to go back and start working again at age 70 or 72 or whatever. So those are the facts we're looking at here. Maybe you can think of a business owner or two that has something similar. Now our initial plan here is we're going to do a buyout. We'll have a one-way buy-sell, and it will obligate the business to do the buying out. I'm sorry, it's not one way. It'll be a business stock redemption buyout. There's a $3 million buyout, let's say over 15 years. So from age 65 to age 80, Sam and his wife will be getting those $245,000 a year installment payments. So the total payments to Sam, 3.6 million, so 3 million plus some interest for inflation. And that'll be great. Maybe we could even do a little bit of a bigger down payment at the beginning, however they want to work it. But basically this looks great. However, if we look at that installment payment size, right, 245,000, I'm not sure, we haven't clarified what the annual revenue is for the businesses, but that's a pretty hefty payment. So one idea is to add that DB plan. So what we're going to do here is get rid of that there. What we're going to do here is set up a defined benefit plan. Sam is right in that sweet spot. He's mid-50s. Let's assume we have very few employees in this business. Maybe it's just those two adult children and maybe a few other employees. We could put in, well over 6 figures into the plan each year for Sam. So we're going to contribute for 10 years. Of course, those contributions are tax deductible to the business. And we did the calculations, and we're going to get about a 1.5 million lump sum to Sam when he retires. Okay. Now, of course, that'll all be 100% taxable to him. But now look over here on the right side. We have our we're going to deduct that. We're going to drop that 3 million buyout to 1.5 million buyout. Now, again, if our fair market value is 3 million, we have to keep in mind that that's part sale, part gift. The IRS is going to look at that, and probably they'll need to report some kind of gift. The difference between the fair market value and the actual purchase price or sale price of 1.5 million, there might be a gift of about 1.5 million there. Maybe we can do some discounting. That looks like that's there's some talk of valuation issues in the tax reform bill, but we'll keep an eye out for that. So now, instead of over 15 years at that same interest rate, 2.67% interest rate, it's their buyout payments only 122,000 instead of 245,000 per year. So much more doable. Sam's not as worried about this as far as it being a financial burden to the business and the adult children who will be running the business after Sam retires. So the total buyout payments to Sam will be 1.8. So now Sam's getting a little bit less total. Back here, we're getting 3.68 was the total payment to Sam. Here, this 1.5 plus the 1.8, that's about 3.4 million or 3.34 million. So we just want to keep that in mind. Maybe we can add a life insurance policy inside the DB plan. That is an option as long as the plan document allows for it. And it's all done with non-discrimination and all that. You do have to contribute to all the eligible employees. So just keep that in the back pocket as a possible additional idea here. But this is going to really help Sam. He's going to have his 1.5 million. He can take part of that, put into an annuity. Maybe just, you have to switch it out to an IRA, probably at retirement there. If there is any life insurance in the DB plan, that definitely has to come out of the plan, and it cannot be inside an IRA. So it would just be typically distributed to Sam as a taxable asset. All right. So our third, a lot of information here right now. Our third idea is a SERP buyout, Supplemental Executive Retirement Plan buyout. So here we have a situation with a business owner where they do have an identifiable buyer, and that's somebody that's already in the business. We have our executive who has been just doing a great job, and let's say her name's Carla. So Carla's been doing a great job. She's willing and able to take over the business at the business owner's retirement or possibly premature death. Anytime you have any kind of non-qualified deferred compensation, it's a promise for a future benefit, and it can be a cliff vested type of benefit, or it can be a gradual type of thing. So what we're going to do here probably is have 100% cliff vesting. So in 10 years, Carla, you're going to be vested in this. That's not going to trigger any taxation until you actually get the benefit of payments. But we are going to have a tax deductible to the business payment at that time, assuming all the trigger has been trigger has been hit. In this case, it'll be specified time, 10 years. We just said with any time with deferred comp, you have to have has to be one of those 6 allowable distribution triggers. It can't be anything else. You don't have to include all of these in the agreement, but it just has to be one or more of these 6. And here we have, of course, our specified time. So 10 years, Carla's going to receive that payment, and she'll have the funds now to effectuate the one-way buy-sell buyout from the owner. It is subject to ERISA. It is subject to IRS Section 409A. So we do highly recommend a third-party administrator. It's technically not absolutely required, but so many bells and whistles, so many rules, and so many pretty severe consequences and penalties and taxes if the rules are not followed to a T. Also, just keep in mind, again, this is deferred comp, that if you do have informal funding, it's only informal funding. It has to be reachable by the business's creditors, and it has to be limited to the top hat people. Of course, Carla's our top hat executive. Here comes my doggy. So as long as it's top hat folks and it's informally funded, we're really going to have very minimal ERISA compliance. So keep that in mind, and make sure you have a third-party administrator that is very well versed in deferred comp. So here's how it works. Again, we have, in addition to our one-way buy-sell, let's say in 10 years that business owner is planning to retire. There's that one-way buy-sell agreement. You can even have a term policy as informal funding for that buy-sell. But for the SERP benefit, how do we make sure that Carla has the financial wherewithal to be able to afford to do the buyout, or at least make a down payment and then continue on with the installment payments? That's our SERP payment. We have the business, they buy the life insurance as informal funding. They pay Carla that SERP payout in 10 years. Now Carla has the access to that cash value. I'm sorry, the business has access to the cash value. They make that payment. And now she is getting that stock and buying out the owner. So you just have it, you just have it timed with the one-way buy-sell agreement. You have 2 separate agreements there in writing, and we now have Carla as a successor, and we've been able to help that business owner. Basically, you think, okay, well, we have our accountant saying, well, why, they're paying for their own buyout. Yes, but it's over time. They're going to get a deduction when those retirement benefits are paid out, and it's a successful buy-sell, as opposed to, not being able to have it happen at all. All right, our funding sources. I'm going to make sure we leave some time for questions here, but I think we have a few minutes here to dwell on our possible funding sources. Third-party lender, that's certainly an option. Cash flow, sinking fund, any type of that can include a lot of different things, including cash value life insurance as well. I mentioned term, and certainly term makes sense, especially if you have someone who's maybe quite a bit older, has some health issues. Term insurance can be a great strategy if we're just worried about the premature death. But of course, we talked about cash value life insurance, and of course, we're all for installment payments as we discussed, and it makes sense for a lot of different business owners. Okay, now just to compare life insurance, the different types, of course, term versus cash value life insurance. We have our 3 tax advantages here on the left side. We want to get that tax-free death benefit. Nothing else really provides that, of course, except for life insurance. As long as it's properly structured, we're going to have that income tax-free payment to the beneficiary at death. Then we have our tax-deferred growth of the cash value, and of course, potentially tax-free access to the cash value via loans, or starting out with withdrawals and then switching to loans. With term life insurance, it's great, again, for those who just, if that's all they can afford, that's great. If we're worried about that, that business owner surviving past the term, now what's going to happen? Okay, first of all, they're going to be 10 or 20 years older, whatever the term was, and they also might have a change in health. So that change in insurability is certainly going to make a new term policy that much more expensive. And there's no lifetime buyout option, of course, for term insurance. There's no cash value in there. And then also, hey, let's say if we just outlive the buy-sell altogether, the business parts ways, before they need to do a buy-sell, we've got that cash value access there, for if they own their own policies via controlled cross purchase, or if the business owned the life insurance policies, they can get those policies down to the owners before the business terminates. So a lot more flexibility there with cash value life insurance. Okay, I'm not sure if you guys can see this. People waiting in their waiting room there. Let me get rid of that. So just comparing these various funding sources. Is it tax deferred? Does it assist with a lifetime buyout? And does it provide a death benefit? Let's just start with the death benefit over there. Of course, only term insurance and cash value life insurance provide that death benefit at someone's death. And term insurance is the only one of these that does not provide any help with a lifetime buyout. So all the rest of them are going to help with a lifetime buyout. And of course, growth is the growth tax deferred. There's no cash value. There's nothing to be tax deferred. The death benefit is tax free for term insurance, but for everything else is a no, except for the sinking fund. It depends on what type of sinking fund. What is the asset? Is it tax deferred? And that's typically going to be your muni bonds, and that's about it. Cash value life insurance is the only one that ticks all those boxes. Tax deferred. You can help with the lifetime buyout, and also provides that hopefully tax-free death benefit, most likely tax-free death benefit. All right, quick case study here, just to give another, it's kind of a little bit of a twist on our SERP buyout. But instead here, again, we have our 55-year-old business owner and his wife, and it's a tax prep service, and it's worth a little bit less. It's worth about $2 million instead of Sam's business, which is worth $3 million. He wants to retire even a little bit faster. He wants to retire at age 62 in about 7 years. So how's he going to do that? He wants to get that business down to his 2 adult children at retirement. And he wants to make sure he has sufficient funds to provide for Madeline upon his premature death. Again, and the kids here, we're just assuming there's not any funds to buy the business. So Greg and Madeline, how can we help them out? We can have a one-way buy-sell agreement here. We're going to have the kids be the buyers. They're going to be doing the buying out of Greg, and then they have this funded with a life insurance policy, of course. Well, how do they afford that life insurance policy? We get bonuses from the business down to those children, and those bonuses will be tax deductible, assuming it's reasonable compensation to them. And then, of course, the children will pay tax on that. Business can gross that up and cover those taxes, so they're net out of pocket $0. So of course that they'll have that cash value available there to effectuate the buyout at Greg's retirement. They can make a down payment, then 10 payments with the business funds, presumably, or if Greg passes away at that point, then they can use the death benefit to pay the rest out to his estate and their mom, Madeline. So they're really simple, no bells and whistles. We don't even really need technically an agreement for that bonus. They could put one together if they want to. That's not an issue. Just a very simple spin off of the SERP buyout. So really, this is like a number 4 strategy idea. All right, here's our diagram just to show you how it works. Greg is our business owner. Remember, we have bonuses from the business for a $2 million life insurance policy on Greg's life. The kids are going to own that policy on Dad's life. At Greg's retirement, the kids can access that cash value, again, withdrawals and then loans for a down payment and installment payments. Ideally, we want to get this policy in, and have it in place, 8 to 10 years before they start accessing the cash value. If you start too soon, it really it has a big impact on the cash value of the policy, and it may not be sufficient. I just want to make sure the timing is right there. 7 years is still okay in this situation. I'd say 7, 8, 9 years is ideal, especially if they're packing in the premiums pretty healthily. At Greg's death, of course, that death benefit it pays to the kids, and they complete the buyout, and that goes to Madeline, the mom, and she has that family projection, and then the one-way buy-sell is complete. So as we've been talking through here, hopefully you've been able to think of some business owners who may need to do some planning, not just business planning. I would say if there's someone who needs to do estate planning, keep in mind, of course, with tax reform, there is a provision, as you probably have heard, that we're having that exemption amount. So going back down to 5 million per person. So these strategies we've talked about here are, these people needing to retire, they need to boost their retirement income. They're probably not needing to do any estate planning. But if they need to do some estate planning, we have an option, especially for a family business, or at least a closely held type of business. And it's called an estate tax liquidity using an entity redemption. So that's a whole presentation of its own. Definitely let me know if you have any questions on that, but it allows an ILET to own the life insurance instead of the business owning the life insurance. For those business owners who want to exit the business and they want to have some kind of way to get the business down to the successor, but they don't want to increase the size of their estate. So none of these ideas that we've talked about today are really going to help with someone who needs to do that estate tax planning. Just make that point. All right, and as I said, we are here to help keep an eye on tax reform, but just in general to make ourselves available to you all and answer questions. Here's our general inbox email and our general phone number. And we have tons of materials, of course, which we're constantly updating every time there's tax reform. All right. Well, hey, Carla, I see your picture there.
Stacey, so there is a question in the chat. Can you track back to the DB situation and explain one more time the scenario? I lost what happened to the payment. I lost what happened with the payments at SAM once they went down to less than the 3 million that he was looking for.
Okay. So I think the slide is what the question asker is talking about here. Yeah, so our total buyout payments are only 1.8, right? That 122,000 over 15 years. But we also have that lump sum payment from the DB plan of 1.5 million. So yeah, we're definitely, this is coming from the business. These payments are coming from the business to SAM, 122,000 a year for 15 years. Now at the end of that 15 years, of course, they stop. Or they could stretch it out to 20 years if they wanted to do that, smaller payments. So that's the buyout payments. And all we're doing is adding the DB plan. And we assumed that we could, typically are going to have a lump sum from the DB plan, and that goes to an IRA for Sam. So he can pull those out. He doesn't have to start pulling that out until age 72 with his required minimum distributions. There is talk in Secure Act 2.0, which is nobody's really heard about that recently because everything's taking priority over it. But if they do implement Secure Act 2.0, there's talk of possibly even raising that higher than age 72. We'll see what happens with that. But I hope that answers the question. So yeah, we got our DB plan lump sum payout and our installment payments for 15 years of 122. So this total 1.8 and the 1.5 is 3.34. So still more than the business, but maybe not as high as we had with that $3 million buyout with the doubled installment payments. So it just makes it much more likely for that business to be able to, make those payments and effectuate the buyout.
Hey, Stacey, does Sam have to continue to be an employee?
I'm sorry?
Does Sam have to continue to be an employee to be eligible for the DB contribution?
Yes, but he's 55, right? He's making those contributions, while he's still working.
Gotcha.
But yeah, that's the 10 years. So yeah, we have Sam. Yeah, I think it's 55. Yeah, it's 55 through 65. He's making the business is making those contributions for him, and then he retires, of course, and now he's not eligible at that point.
Perfect.
Okay.
Great. Thank you so much. This was a great presentation.
All right. I know everybody's been sitting through some hours of CE here. So, if any other questions pop up, definitely feel free to reach out.
Great. And Stacey's contact information as well is on the website for the Advanced Practice Center. Great. Well, thank you, Stacey.